Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories that we are tracking for you in the BNN Bloomberg newsroom. CIBC shares are up today. The bank raised its dividend and beat revenue estimates in its fourth quarter as it reported a 16% surge compared to the year before. Strong performance in its capital markets business helped drive results, and the Toronto-based lender also saw strength in its Canadian and U.S. commercial banking and wealth management units. The bank also decided to boost its dividend to $1.07 a share. CIBC is continuing a two-year streak of earnings beats. Shares of Bank of Montreal are seeing some pressure today. The lender beat earnings and revenue estimates in its most recent quarter, but investors seem to be focusing on a drop in net income. BMO says that metric came in lower due to the reversal of a legal provision in the previous year, a write-down related to its planned sale of branches in certain U.S. markets and costs from acquisition-related assets. In October, BMO struck a deal to sell 138 branches in 11 states to First Citizens Bank and Trust. Shares of TD Bank are edging higher. The lender reported profit and revenue in its latest quarter that topped estimates, driven by record results in its capital markets unit. TD's U.S. business also fared better than analysts had expected. That segment remains under an asset cap as part of its anti-money laundering settlement with U.S. regulators. TD also boosted its dividend. And taking a look at the markets, a rebound for the TSX, second day now. It's up it's up about 0.8% right now. And south of the border, a similar situation we are seeing. Oh, now, what a change. They were in the green a little while ago. Now it's on a little bit of a reverse, but pretty much a wash right now. You can see the S&P 500 0.06%, virtually negligible. Dow Jones the same, and the NASDAQ at 0.1%. So pretty much right now it's flat. Well, TELUS stock is up today as the company hits pause on its dividend growth plan until it says its share price reflects its growth prospects. For more on this, we're joined by Doug French, Executive VP and CFO at TELUS. Doug, thanks very much for joining us.
No problem.
Let's talk a little bit about that. You raised your dividend last month, and then yesterday you announced the pause. What's the rationale for this?
Yeah, our share price had been under pressure. And the dividend yield had increased to a level that we believed warranted then the pause on the growth. We don't believe the share price currently reflects our growth trajectory. And with the yield being higher, we did the pause until the recovery of that share price occurs.
Now, investors had some concern about that. Is that where that's coming from?
There were certain investors, but we've had a very clear, consistent plan on how we are going to deleverage, remove our discounted DRIP, and continue to execute as we have on our operational execution. And so we believe, some of the interpretations are not aligned with where we believe our organization is going.
And just first with the pause, how long is that pause? Any idea?
No, it's to be determined. I think we'll wait and see when the yield is more reflective of the value that we believe our organization will contribute. And so it'll be up to our board to decide with management when we will put the growth back on. But right now there is no set date.
And with the DRIP that you mentioned, why not just remove it entirely?
We have had significant expenditures over the past few years on spectrum. We've also led the industry in our fiber build. And so the step down of the discounted DRIP is to, in essence, complete our free cash flow maximization, I'd say, in the short term, as we pay for some of those significant investments. But we were very clear, very transparent on our approach to do that, while deleveraging to 3.0 of debt to EBITDA in the same time frame.
And any concern about investor reaction to it?
I think the reaction yesterday and the reaction that when we be reaffirmed where we were headed was very positive. I think we're seeing a lot of support for our organization with institutions. A lot of even the analysts and the Canadian analysts, which are following, have all got buys and target prices on us in a significantly higher than we're currently trading at. So I think it's now we just need to continue to execute and show exactly what we are doing back to the markets. But I do believe the announcements we made and the confirmation we've made over the last 24 hours, it's just reaffirming the trajectory we were on, and it was well received by shareholders.
And also, you announced today that you're repurchasing a series of outstanding bonds for cash. This is the latest one. There have been several this year. Where are you heading with that?
Yeah, so there's certain of our bonds that are trading at discounts, and it just gives us an opportunity to purchase some of the debt back, and it's part of, again, of our deleveraging plan, so that we will be down to that 3.0 leverage level in 2027, and so it's all part of our comprehensive plan to do that.
And one of the things people have been, there was a story on a little while ago, copper, and people don't necessarily think about it. There was talk you had up to $1 billion possibly in copper waiting to be harvested from your lines. Where is that now with copper prices sitting at closing in on record levels, around record levels? Has a lot of that copper been salvaged, or are you waiting?
So we call it urban mining. We've been mining our fiber or our copper as we complete our fiber builds. We can remove the copper when all of our customers are off it, and so there is a bit of a migration to our fiber network. Our fiber network is leading edge. We have a market coverage that is probably one of the leading in the world on one of the best technologies, if not the best technology for delivering internet, which has allowed us to free up that copper. And so I would say we're still in our infancy. We've probably only been a little less than 10% of the copper we have has been able to be monetized to date. But it's going to be very steady over the next few years in the monetization opportunities.
And one of the other things that people are talking about, AI, of course, where are you within AI and how are you using it, and what kind of do you see savings? Are you starting to see savings with AI?
Absolutely. So we've been putting in AI agents throughout our organization to improve customer service and improve effectiveness. We have our own data centers, and we are also selling to our customers solutions of GPU sales, in addition to helping them develop their own AI agents and train their models. And so we've been able to do both fronts. One, utilize it for our own efficiency, for our own customer service, and improving time in which our customers spend through administration work with us. And then in addition to selling similar solutions or solutions to our customers that allow them to do the exact same thing on our wholly owned data centers.
And how has that been going with the data centers? We've heard some struggles for some people. How have the build-out's been going for you?
It's been going very well. We already had the data centers and we had capacity. So putting in the NVIDIA chips and the GPU sales opportunity was fairly easy and not that expensive for us to get it in. So now it's getting utilization with our customer base, and we do have customers now using it, and I would say it will continue to grow over the next few years. But we're very excited that we're one of the first to have a sole sovereign data center in Canada, allowing data sovereignty for all of our customers, but also being able to be fast out of the gate and offering that GPUs so that organizations can also digitize and become more efficient and effective themselves.
Okay, Doug, thank you very much for joining us today.
Thank you very much. Have a great day.
You too. Doug French is Executive VP and CFO at TELUS. Up next, we'll get more on the market. Stay with us. All right, let's take a look to the markets now with Uma Moriarty, the senior investment strategist at Center Square Investment Management. Uma, thank you very much for joining us.
Thanks for having me, Roger.
You have some optimism for as we look at things like global growth. It's going to slow but steady. What's your reasons for some of the optimism right now?
I think where we really are at this point is that we are seeing a little bit of stabilization, slowing to your point, but still relatively healthy. And I think a big part of that really around the world has been this consumer base that has remained a lot more resilient than we expected. And so I think that's really helping. The other piece as well is this really large build out from an infrastructure perspective, whether it's digital infrastructure and you think about the impact of AI and what that means around the world, but also just regular infrastructure, right? We're seeing infrastructure spending around the world, and all of these things are really playing into helping growth remain relatively stable, though slowing a little bit from where we have seen this past year.
And with that consumer resilience, because we hear horror stories. There's layoffs, nobody's moving, there's not hiring, concerns about inflation. Where's that resilience coming from? Do we know?
I think it's really this K-shaped economy that you are seeing, right, where you have the higher end of the consumer that has been benefiting from things like asset valuations. You're seeing the housing market really, really strong. You're seeing values across the stock markets really strong. That asset is really helping the high-end consumer continue to be strong across the board. And at the same time, you're seeing the other side of the economy, the lower-end consumer, continuing to really struggle because although inflation has come down around the world, it's still at levels pricing wise elevated compared to where it was 3, 4, 5 years ago. And so you're seeing the lower end consumer being a little bit stretched from that perspective, but you do see this K-shaped economy where that higher end consumer is continuing to spend, and that's really helping buoy the entirety of the economy. But to your point, from the labor market perspective, that is an area of concern, right? If that is something where we see a large amount of layoffs, for example, or we see a big correction in the stock market associated with kind of this potential bubble for AI that a lot of people keep talking about, maybe that comes off. If you see asset valuations really hurting for the higher end consumer, I think that really brings down consumption, and that would be a hit to economies around the world. But as far as we can see at the current moment, it seems like the current environment seems like it could continue for the foreseeable future here.
And now one of the things people have to buy, or don't have to, but often do, real estate. You either have to own somewhere to live or you rent. It's an interesting place right now, isn't it?
Absolutely. I mean, I talk about real estate, and that's what we do here at Center Square. And it's an asset class that provides a lot of stability in otherwise areas where you might be concerned, right? So take this AI potential bubble that you keep hearing people talking about across the equity markets. Global REITs around the world are trading at meaningful discounts compared to equities versus their historical levels. They're trading at levels that we saw kind of after the global financial crisis. So think about what that particular environment meant for real estate. And that's where we're trading from a valuation perspective compared to global equities. And it's a really great opportunity, I think, for investors to find a little bit of what real estate offers within a portfolio, which is the cash flow, it's the inflation protection, and it's doing so from that liquid equity market perspective. So global REITs look really interesting here today as we see a lot of valuations being stretched across the broader equity market.
Now, are there certain areas that are looking better than others when it comes to the global REITs?
Absolutely. I think where we're really focused on is identifying areas that have secular growth. And by that, I mean things that might not be impacted based on what happens with the economy, right? So I mentioned from a labor market perspective could be a risk for the consumer. However, there are aspects of the global economy that are going to continue. And one of those areas is what's happening from the aging population around the world. We see that here in the US in a really material way, impacting the growth that we're seeing for senior housing, for example, within the real estate space, where you are seeing record levels of aging into this needs-based type of an environment from a real estate perspective. And there's essentially no new supply of senior housing. And we're seeing this lack of supply across various different aspects of the real estate space. But I'm highlighting this from a senior housing perspective because this increasing demand coupled with this low supply is creating some really phenomenal growth associated with the income that's being generated out of senior housing real estate. And so that's an area that we're really optimistic about. It's an area that I don't necessarily see anything really hurting the story in the foreseeable future because new development still does not pencil. So we don't see a new supply wave really impacting fundamentals. And at the same time, you see this demand continuing, right? We're really just at the very beginning of this massive wave of the aging baby boomers that are going to be coming into this demand driver for senior housing.
I was going to ask, but you just answered that question about you see that wave continuing. What about going back just to the bigger picture for a second? You said it's trading at 30%, I think is the number. You didn't say it, but I think it's the number you have written compared to historical levels. Is there more room for that to drop, or are you thinking it's maybe starting to hit the upswing again?
I think what we have seen over the last couple of years is a lot of concentration within the market. And I think we're starting to see that breadth kind of normalize. The other piece that's going to be helpful for real estate really is a normalizing interest rate environment. What we have been dealing with in real estate over the last several years is kind of the onset after the pandemic. You saw a really strong drop in interest rates that was followed by a really sharp increase in interest rates to fight inflation. And that the uncertainty from an interest rate perspective is not great for real estate, right? It is a somewhat bond proxy in the listed environment. And so now that we have a little bit of stability from an interest rate perspective, I think that really creates a great environment here for REITs around the world where you have a bit more certainty in terms of what's going to happen associated with interest rates. And I think that's going to create an opportunity as the market breadth kind of expands here for REITs to start participating in the global marketplace.
Okay, we're going to have to leave it there, but Uma, thank you very much for joining us.
Thanks for having me.
Uma Moriarty is Senior Investment Strategist at Center Square Investment Management. Coming up, shares of Snowflake are under pressure after delivering an underwhelming outlook. We'll find out more after this. Snowflake beat on its third quarter sales expectations, but forecasts slower product revenue growth for the fourth quarter, and that has put shares of the AI software maker under pressure. You can see it's off by more than 11%. Let's find out if investors are overreacting. Joining me now is Ivana Delevska, founder and CEO of Spear Invest. Ivana, thank you very much for joining us.
Thanks for having me, Roger.
So, are they overreacting?
Well, Roger, they're not really overreacting because if you look at the numbers, we did see deceleration in terms of the product revenue growth quarter over quarter. So while it was still a bit compared to consensus, investors would like to see acceleration for some of these higher multiple stocks. So I wouldn't say it's necessarily an overreaction. We still see upside in Snowflake in the long term. This is not a top pick for us right now because we think that we are ahead of the next wave of infrastructure investments in AI. So you first need to put the infrastructure and then companies like Snowflake will see the benefit.
And with this, they came up short. Are we hitting a point, though, where it's not realistic to expect them to do even better than what we think they're going to do?
Well, I think in the long run, let's say on a 2 to 3 year basis, I think they're going to significantly exceed analyst expectations, right? The question right now is a lot of these concepts like AI agents are very in early innings. So they need to be gaining broad adoption for companies like Snowflake to benefit. So really the beneficiaries right now are going to be the companies providing the picks and shovels into the build out. Mm-hmm. And then after we have the infrastructure build out and cost to use are significantly lower, that's where you're going to see Snowflake continue to post outsized beats rather than just coming slightly ahead of consensus.
All right. And what are some of the picks and shovels that you're liking?
Well, we really like the networking space, both on optical cables, electrical cables, basically everything that connects the GPUs. Some examples would be Astera Labs, Credo Technology, Marvell. Marvell and Credo reported earlier this week outstanding results. significant growth, both projected and in the current quarter. So I think this is really where investors should be focused on. And we disclose all of our holdings on our website.
And you mentioned the GPUs. Let's talk a little bit about GPUs, TPUs. I think people were just getting used to one. Now they've added GPU in, and other words, TPU in. What do you like within those, and what are your concerns?
Well, that's been a new debate right now, right? Whether Google's newly introduced TPU will gain market share from NVIDIA. I think it's very important for investors to understand that the TPUs perform really well, but they're optimized for recommenders. So this would be applications like Google's internal recommenders that they use to recommend you ads. So anywhere where that type of model needs to be used, their TPUs will perform very well. So this is why there was news that Meta may be considering trying this. So anywhere where you see recommenders, we see Google making significant inroads. Now, when it comes to general purpose computing, that's where NVIDIA has really the lead, because they offer a lot of free libraries and tools that sit on top of the GPUs. Mm-hmm. So Jensen made a comment that even if their customers give away their GPUs or TPUs for free, NVIDIA would still have an advantage. And this is really what that's referring to.
And do you feel there's room for both, or could we see a point where there maybe is only one winner from this?
Absolutely. We see room for both. We actually see room for multiple players. Amazon with their Trainium chip is also making significant inroads. So I think over time, what's going to happen with this space is that there is going to be application-specific GPUs for some of the large markets. So right now, one example is recommenders, right? But as we go forward, maybe robotics or maybe some of these large end markets that emerge don't need to use general purpose GPUs and run all these unnecessary tasks. They can just run the tasks that they're needed. So that way you can achieve significant cost savings. So we think over time there is going to be room for many players. The market is pretty big. So I think the concerns are overblown at this point.
Okay. Now, and you mentioned earlier about Meta, been a significant underperformer this year. What do you want to see change there?
Well, with Meta, Roger, the key is going to be to see this investment, this massive investment that they're doing, to see it driving results in terms of profits and revenue growth. So every time Meta comes slightly ahead of consensus or in line, given so much money that they're investing, that's going to be disappointing. So this is why when the news came out that they're scaling back on their metaverse investments or plans, people think that that's a positive for the stock. For us, we would really need to see these investments reflected in results. I think they ultimately will. But again, similar to Snowflake, you first need to put the infrastructure in place before you can see the next wave of benefits of AI.
And what would be results to you? What would you like to see for results?
Well, I think it's going to be significant acceleration in their revenue and profit growth, right? Like they haven't really been posting very strong numbers this year. And this is why you see the stock underperform. If you remember, in 2021, there was all the TikTok discussions and they faced similar headwinds in terms of revenue growth. They were able to turn this around with the first generation of chips like the Hopper, right? So results showed pretty significant improvement. And now we're ahead of the next wave with the Blackwell architecture and maybe even TPUs that they are able to use at a lower cost. So we would like to see if that can reaccelerate revenue growth.
All right. And just before we go, bigger picture for AI heading into 2026. What there fears of it frothy, it being a bubble. What do you feel we're going to see in 2026?
Well, we see a lot of people really scared that this is a bubble. We don't believe that's the case at all. And this is because we do boots on the ground research, talk to companies, and we really have good visibility in how much investment is going to take place over the next 3 years. So I think from investment perspective, valuations don't scream expensive at all. In fact, companies like NVIDIA are trading near the low end of a 5-10 year valuation range. So I think it's very important for investors not to miss this next wave of AI investments. Of course, there is always risk and there is always companies that are over-promising and under-delivering. So it's becoming even more important to do fundamental research and pick the right companies. But I think there's significant opportunities ahead, so people should really focus on this space.
Okay, Ivana, thank you as always. Ivana Delevska is founder and CEO of Spear Invest. When we come back, TD, BMO, and CIBC all beat estimates in the latest quarter, supported by strong performance in their capital markets businesses. We'll dive into the results after the break. Shares of BRP are getting a boost in today's trading. It's up 7%. That's after the maker of all-terrain recreational vehicles saw revenue surge 15% compared to last year in its latest quarter. It also posted higher profit that topped expectations. The results were driven by higher off-road vehicle deliveries and new product launches. BRP also hiked its 2026 forecast for profit and revenue and will buy back up to 10% of its shares. Descartes System is one of the best performing stocks on the TSX today. It's up nearly 11%. The software firm reported revenue in its latest quarter that jumped 11%, exceeding estimates. Revenue in its service segment also topped expectations, 16% higher than the year before. Descartes warns, however, that continued uncertainty and tariff volatility are contributing to forecasting, planning, and execution challenges for its clients and customers alike. Shares of Canada's Horizon Aircraft are up today. The innovative aerospace company announced it has partnered with UK-based Motion Applied to design a key component for its hybrid electric flying taxi. Motion Applied, which split from the McLaren Group in 2021, supplies engine control units to several motorsport series and makes electric vehicle charging equipment. Quick look at the markets right now. You can see TSX on a nice run right now. It's up nearly a full percentage point, and south of the border, we're looking at a mixed bag, almost a wash really when you look at the S&P 500 and the NASDAQ. They're pretty much neutral right now, and even the Dow Jones is off by 0.1%. Okay, TD, BMO, CIBC all beating estimates in the latest quarter, supported by strong performance in their capital market businesses. Let's break down those results further with Bloomberg's Christine Dobby. Christine, thanks for joining us. And the calls this morning, any themes emerging from them?
Yes, I mean, as you can imagine, lots of discussion about the macroeconomic outlook. And I would say there was a tone of cautious optimism. That's something we saw from the other banks earlier this week, too. You know, not expecting any sort of terrible outcome in either the U.S. or Canada, but also there is still uncertainty overhanging everything, as we talk about all the time. You know, with the uncertainty around the CUSMA renegotiations and where that's going to land. I would say the banks were a bit more optimistic on the state or the fate of the U.S. market versus Canadian. There were some concerns about growing stress in the Canadian consumer market, particularly at the lower income end of things. And that's something that came up quite a bit, or at least a little bit on the BMO call today. And I think that could be contributing to some of BMO's stock performance today. They're the only Canadian bank stock that's in the red this morning.
Yeah, it's off noticeably right now. There were some record numbers, especially for the U.S. And I was trying to find which bank had a record day south of the border. I don't know if you can see it off the top of your head. I know there's been so many numbers bounced around.
Yeah.
But there were some record numbers, especially in the capital markets. So the banks were quite happy. But are there trends overall that we saw in this quarter? I guess the capital markets, by the sounds of it.
Yeah. Yeah, I mean, definitely we saw that was the big theme for the quarter and really for the year. Very strong capital markets performance pretty much across all of the banks. And it was interesting to hear that they do expect some of that momentum to continue into next year. We saw really buoyant markets this year, led to a lot of trading activity, and they made a lot of money off of that. We've also seen a return of some deal making, particularly in the United States. So some of that advisory work has come back. And then, we saw fairly stable credit trends across the banks. And while I don't think that they're expecting any sort of rapid normalization next year, there's no forecast of bad outcomes in credit for next year. It's sort of remaining relatively stable. And we didn't see any big surprises on provisions for credit losses like we had been seeing in some of the previous quarters.
Okay, so it sounds like steady as she goes.
Yeah.
All right, we'll leave it there. Christine, thanks very much for joining us. Bloomberg's Christine Dobby. Well, coming up, EQ Bank has announced it's acquiring PC Financial, the financial services brand of Loblaws. That's next. Okay, EQ Bank has announced it's acquiring PC Financial, the financial services brand of Loblaws. And the news seems to be benefiting both EQ and Loblaws today. For more now, we're joined by BNN Bloomberg's Lindsay Biscay. And Lindsay, just what we thought, well, we're just going to have earnings this week, and then all of a sudden we get all kinds of news of sales and changes.
Exactly, and this is the latest one, an $800 million deal. So this is pretty interesting, and according to both of these two companies have both kind of pioneered when it comes to like higher interest accounts, no fee accounts. Now you're combining the two, and you get EQ Bank with its digital services, also with PC Financial with its kind of access to in-store services, retail, and credit as well, because EQ Bank now taking on the seventh largest credit portfolio in the country with 2.5 million customers. EQ Bank has 800,000 customers. So this is going to benefit both when it comes to kind of the digital side of things, as well as EQ Bank customers can benefit from PC's financial credit cards, PC Optimum, as well as access to retail banking at some 2,500 Loblaw stores and ATMs across the country, right? You see ATMs everywhere for PC Financial. It's also believed to benefit Loblaws because now Loblaws can take that data from EQ Bank, from the digital side of things, and kind of look at how people are shopping, where they're buying, and then tailor advertising to them. And
Loblaws is going to be like 16%. I think they have their ownership of it. If I'm trying to remember the number I saw, I think Loblaws.
17% of the shares, of the common shares of EQ Bank. So a lot of benefits here for Loblaws.
All right. So what are the analysts saying?
Yeah, so Desjardins is saying that this benefits Loblaws in a lot of ways. It's not imperative to Loblaws sales, but it is saying it will simplify the operational structure when it comes to Loblaws so they can focus more on retail rather than the financial side of things. Raymond James, meanwhile, saying that they can focus more on EQ Bank. They're saying that this is beneficial over time and it's maintaining market performance.
Okay. And the interesting thing after all this, though, I lost my train of thought for a second. You okay over there? Got some water in here?
No, thank you.
But the interesting thing, too, is we've had the earnings all this week, and EQ missed. Are you all right? Do you want to take a break? You're going to be okay? Okay. EQ missed on its earnings.
Yeah, so this was not the best news for EQ Bank, right? When we're seeing other banks kind of overperforming when it comes to their reportings. They missed estimates this time around. It appears credit remains an issue for them. They've had kind of some shaky loans as of late. And so the bank reporting the adjusted earnings per share of 1.5%. That's compared to the consensus of 1.9. So they adjusted their net income as well to $63.5 million. And we've seen credit be a problem for this company in the past, right? The CEO saying today, this is a relatively new CEO, saying that the company responded this time by announcing a one-time restructuring program, which drove a charge of $92 million in pre-tax. And so they say EQ Bank, for example, this is what they call the crown jewel. They say they saw 18% year-over-year growth in customers, 10% growth in deposits. And so the stock price is up today as a result.
Okay. On that note, we'll leave it.
Thanks.
Go get a drink of water. Lindsay, thanks as always. BNN Bloomberg's Lindsay Biscay, Live TV. Well, for more on EQ Bank's earnings, we have Chadwick Westlake, the president and CEO, on trading day this afternoon. It's at about 1:40 p.m. Eastern time. Coming up, hot picks. We'll look at 3 plays in software after this. Time now for Hot Picks, and today we zeroed in on the software space. We were joined by Tyler Radke, Senior Equity Research Analyst at Citi. We started with his first pick, MongoDB.
MongoDB is a provider of databases. Databases are essentially the foundation for building applications. So everything from a traditional SaaS application like a Salesforce.com to a mobile application to something that might be customer facing or back office facing, all of those need things like a database to store, manage, and run that data. This is a very large market today, over $100 billion. Obviously, you have companies like Oracle dominating the space. But I think what's really interesting about Mongo is one of the big breakthroughs that we've seen on the AI side is just how easy it is to write code, right? You've seen many of these code completion, vibe coding startups really drive explosive growth, and the output per developer is increased in terms of orders of magnitude. So what does that mean? It means that more lines of code are being generated. You need more databases to store and manage this data. And I think the pace in which you're modernizing legacy applications, so there are applications that were written 20, 30 years ago, that's becoming a little bit easier and happening a little bit faster. And so we think that can be an accelerant to growth. They reported earnings earlier this week. We saw their Atlas cloud revenue accelerate to 30% plus. They have a new CEO who's bringing in, I think, a lot of Fortune 500 relationships. So we think there's a lot of positive tailwinds ahead for the business.
Snowflake is seen as another winner in AI. Remind us what they do and what is their AI angle, please, Tyler.
Yeah, sure. So similar to MongoDB, they are in the database space. They specialize more in data for analytics and for doing business intelligence and those types of use cases as opposed to databases. So these are sort of two distinct markets. Been a very high growth business since its IPO. They did report last night, kind of missed expectations after the bar was pretty high. As you can see, the stock has had a good run this year. But their secret sauce on AI is basically, I think they've done one of the best jobs of actually embedding AI capabilities into their products. So what does that mean? Typically, Snowflake, if you looked at this product in the past, you would have to be an expert in writing SQL queries. You would have to know how to code and be more of a technical user of the product. Today, you can use their Snowflake Intelligence product very much like you and I would interact with a natural language search, ChatGPT. You can ask questions about the data that sits under Snowflake. And so basically this is opening up a wider range of users that can engage with the product, and they make money based off the number of queries you have. So we're really seeing the growth rates accelerate. I think this quarter was a little bit of a blip, but we expect them to return to growing their revenue over 30% next quarter.
That's interesting. So you get billed on the number of queries your employees put through?
Exactly. And it's similar for Mongo. And I think the reason why these are some of our top picks, right, is that in software, the software sector has been under a lot of pressure. And I think there's a lot of uncertainty in terms of the way that software applications are going to look long term, right? Because many of these traditional software businesses, whether it's Salesforce or Workday, et cetera, they charge based on the number of seats, the number of users, right? And so clearly there's a lot of uncertainty. What is white collar jobs going to look like? What is knowledge workers, developer headcount going to look like? But we do know data volumes are increasing. We think the number of queries are going to grow. So structurally, I think these business models and their technology is just kind of better positioned for what's coming.
And finally, what many people would think is an old reliable in software, Microsoft. What is particularly catching your eye about this name right now, Tyler?
Yeah, look, I think Microsoft is, in our view, this should be a core mega cap holding, right? It's sort of been our view for the last 5 years, and I think it's generated amazing returns. Clearly, the stock is pulled back a good amount from its highs. I think anytime you do get these pullbacks, they're great times to add. I'd say specifically on the business, what gives us conviction. If you look at last quarter, well, yeah, maybe you could say the Azure growth was a little bit underwhelming. We were really impressed by the bookings that you saw. So the commercial bookings meaningfully accelerated. So they're signing a lot of these large deals. Some of those are with OpenAI and everything, but a lot of this is coming from their large corporate clients. And so we think as they get new capacity on, these PowerShells stood up, you're going to see their Azure revenue growth accelerate. We think this company can grow earnings per share well over 20% over the coming years. They're well positioned on AI and doing everything right in terms of operating with discipline. They're holding operating margins. They're not going into kind of more speculative businesses, and we just think that can kind of drive compounding growth over time.
Anyway, speaking with Tyler Radke, a senior equity research analyst at Citi. Well, Algoma Steel in Sault Ste. Marie, Ontario, cut about 1,000 jobs this week. People in the city are noticing the anxiety in the air. The community is coming together to help those who have been laid off. Heather Wright from CTV has more.
Sault Ste. Marie, Ontario is technically a city, but people who live here say it's more like a small town.
I've been seeing anxiety in a lot of people's eyes for a long while now.
Dan Trevisanute knows his neighbors are hurting, and so he's discounting haircuts and beard trims for Algoma workers impacted by Monday's layoff announcement.
It's the least I can do, and a little bit of affordability to offer these people dignity, because they'll be looking for jobs, and there'll be a lot of people just going to be in a bad way.
1,000 people are set to lose their jobs, a direct impact, the company says, of Donald Trump's tariffs. Tariffs that are hurting people on the other side of the St. Mary's River in Sioux, Michigan.
Definitely, there's been a pinch.
Jennifer Riatoir has owned the mole hole for more than a decade, but in the last year, she's watched as tariffs have squeezed her margins.
Some of our vendors do try as well to absorb it for a while, but ultimately they pass it on to us. We absorb what we can, but we also can't absorb everything. There's just not enough room for it, and so everybody pays for tariffs.
While tariffs are most acutely felt on imported hard goods, prices have also risen at the grocery store.
Everything is going higher, and we're doing okay, but I think there's a lot less fortunate people that have to really struggle.
Back across the border, there are concerns about the impact the Algoma layoffs will have on the broader community. At Peter Ma's normally busy restaurant, this week has been extremely slow.
This is a steel town, and everything is based on Algoma Steel. So if we're laying off 1,000 people, that's a big number of people. We only have 72,000 people here.
The Algoma layoffs don't go into effect until March 23rd, giving affected employees a little less than 4 months to find a new job.
Well, there soon may be fewer Air Transat flights on the runway. At this time next week, it's roughly 700 unionized pilots could be in a position to strike. Annie Bergeron-Oliver has more. All right, we're having some technical issues with that story. We'll get to it if we can, but let's take a look at the markets and see how things are shaping up on this trading day. And we're going to start with the TSX and take a look at that. And right now, it is in record territory. It's having a good day. It's up by more than 1% right now and is at record high numbers, and 31.449, 40.491. It's up and down right now, but it is in record territory. A lot of that is being driven by the banks. Let's take a look and see how some of them are doing. TD, I'll call that up first, and we'll get to EQ at the end of this. But TD right now, it's up $1.49 right now, so it's up at 119 or a little more than that. Bank of Montreal, you can see it's up. These numbers are lagging a little bit from what you're seeing on the screen. But Bank of Montreal, though, it's the one that people are worried about right now. It's off by 1.45%. But going the other way, CIBC, it is up 3%, more than 3% right now. All of them reporting their earnings today. And for most part, they beat all the estimates. The one of interest right now, though, and it's one of the movers, is EQB. Let's take a look at that. And that is surging today. And a lot of that, of course, on the news that it's going to buy PC Financial for an implied price of $800 million. So you can see it's up 12% almost right now. So those are some good numbers. People obviously like what they're hearing about that. And let's move on. I think we've got that story now. We want to get to it just before the end of the show. And it's about Vancouver Island. There's a pulp mill there. It's closing just 3 weeks before Christmas, and a lot of people trying to cope with this. It's a historic Crofton mill. About 350 jobs are going to disappear. CTV News' Andrew Johnson has more.
Most people in Crofton, BC can't remember a time when there was no mill.
It's been an institution of Crofton since the 50s. It's a very big change.
Very upset. I mean, it supported our family and so many families in this town.
Now, 3 weeks before Christmas, 350 workers have learned they will soon be out of a job and the pulp mill will close for good.
It's a real punch to the gut for our whole community. To lose a good union job like this is tough any time of the year, but to get that news right before Christmas is devastating.
Mill owner Domtar says the mill has been losing millions for years, and U.S. tariffs that have been hammering the softwood lumber industry aren't the issue. Instead, the company is blaming government regulations, saying logging approvals that used to take weeks now take years, and they've actually been forced to source wood fiber from the U.S.
It's cheaper and it's more readily available and dependable in terms of its supply, and so that should give an indication to British Columbians of where we're at.
The official opposition claims the NDP government has been using the Trump trade issues as a scapegoat.
Tariffs aren't the issue. That's all we've been hearing in the House. It's Trump's fault. It's Trump's fault. It's not Trump's fault. It's this government's fault.
Today, the Premier acknowledged forestry is in a tough spot.
The combination of pine beetle, the need to protect old growth, forest fire, and low prices is incredibly challenging.
The Premier says the BC government will try to figure out a way to keep the mill open and salvage those good-paying jobs. But for now, Domtar will turn out the lights December 15th. Andrew Johnson, CTV News, Vancouver.
And thanks for watching. Market Calls next.